The average American pays 22% in federal income tax. The average real estate millionaire? Often less than 5%. What do they know that you don't? It's not just about mortgage interest and property tax deductions. I spent 6 months interviewing top real estate tax strategists who work with investors worth $10+ million, and I'm about to show you their entire playbook, including how one investor I know turned a potential $87,500 tax bill into zero by legally structuring his real estate activities. Want to know exactly how he did it? Let's break it down. Meet Megan, the $350,000 income with a $0 tax bill. Ever wondered how some real estate investors manage to make hundreds of thousands of dollars while paying virtually nothing in taxes? It sounds impossible, right? Well, meet Megan, our real-world example who pulled off what most people would consider a financial miracle. Megan isn't some trust fund baby or Wall Street wizard. She's a 38-year-old former marketing executive who, just 5 years ago, decided to dip her toes into real estate investing while maintaining her full-time corporate job. Fast forward to last year, and Megan's financial situation looked pretty impressive on paper. She pulled in a total of $350,000 in income. About $150,000 came from her day job in marketing, while the remaining $200,000 flowed in from her real estate portfolio consisting of 12 rental units. Now, if you're doing the mental math, you're probably thinking Megan must have gotten hammered at tax time. And you'd be right. Without strategic planning, she was staring down the barrel of an $87,500 federal tax bill. That's roughly a 25% effective tax rate that would have wiped out a quarter of her hard-earned money. When Megan first saw these numbers, she nearly fell out of her chair. Her initial reaction was what any of us would experience: pure tax panic. Here she was building this impressive real estate portfolio, generating solid cash flow, only to watch a massive chunk disappear to Uncle Sam. That's when Megan's accountant delivered the wake-up call that changed everything. "Megan," he said, "if we don't implement a strategic tax plan immediately, you're headed for a financial bloodbath." Not exactly the news you want to hear, but sometimes it takes a shock to spark action. The good news: Megan didn't just accept her tax fate. Instead, she embarked on a journey to legally shield her income from excessive taxation. And that's exactly what we're going to break down step by step in this video. Megan's transformation from tax disaster to tax victory. What makes Megan's story so valuable is that she wasn't born into wealth or connections. She built her portfolio methodically over 5 years while juggling a demanding career. Her properties aren't in ultra-luxury markets either. She focused on middle-income multifamily units in growing suburban areas that generated consistent cash flow. The real magic happened when Megan began implementing specific tax strategies that are perfectly legal but rarely utilized by average investors. These aren't shady loopholes or questionable offshore schemes. They're incentives deliberately built into the tax code to encourage real estate investment and development. Each strategy Megan implemented contributed a specific dollar amount to her tax savings. For instance, one particular approach we'll dive into later saved her over $43,000 in a single tax year. Another strategy completely eliminated the capital gains she would have paid when upgrading from smaller to larger properties. What makes this story even more impressive is that Megan implemented these strategies while navigating a career transition. During this period, she was scaling back her marketing hours to focus more on her real estate activities, a move that, as you'll soon discover, played a crucial role in her tax strategy. Megan's properties span several types. She owns a mix of single-family homes, duplexes, and one 8-unit apartment building. This diversification not only provided multiple income streams, but also opened up different tax strategy options that wouldn't be available with just one property type. I want to emphasize something important. Megan's approach wasn't about hiding income or doing anything questionable. Every dollar she earned was properly reported. The difference was in how she structured her investments, timed certain activities, and strategically categorized elements of her real estate business to maximize legally available deductions. Think of it like this. When you use a 401k to reduce your taxable income, you're not doing anything wrong. You're simply using an incentive program designed to encourage retirement savings. The strategies Megan used work on the same principle. They're incentives designed to encourage real estate investment and improvement. By the end of this video, you'll understand exactly how Megan transformed her tax situation, reducing her federal tax bill from $87,500 to literally zero, legally and ethically. You'll see the exact roadmap she followed, with each fork in the road clearly marked, so you can potentially apply similar strategies to your own situation. One quick disclaimer before we continue. While these strategies worked for Megan, tax laws are complex and constantly changing. What works for one person's situation might not work identically for another. Always consult with a qualified tax professional before implementing any tax strategy. The beauty of Megan's story is that it demonstrates how ordinary people can use extraordinary strategies to protect their wealth. She didn't need special connections, inherited wealth, or insider information, just the right knowledge and expert guidance to navigate the tax code strategically. In the following sections, I'll walk you through each of the strategies Megan implemented, showing you exactly how much each one saved her and how they work together as a comprehensive system. You'll see how seemingly separate tax provisions can be woven together to create a powerful shield for your hard-earned income. But before we dive into those specific strategies, we need to understand what makes real estate such a uniquely powerful vehicle for tax savings in the first place. There's a fundamental advantage that real estate has over almost every other investment class, an advantage that creates the foundation for all of Megan's tax strategies. The tax game changer. Why real estate beats other investments. The stock market has its dividends and growth, but real estate offers something truly extraordinary, a financial advantage the IRS treats like pure magic. Imagine owning an asset that's gaining value while the tax code pretends it's actually losing value. That's not fantasy. It's the reality of real estate investing, and it's probably the single biggest reason why wealthy investors can report substantial income while paying surprisingly little in taxes. Most investment vehicles only give you two ways to build wealth: cash flow and appreciation. With stocks, you might earn dividends, which get taxed as ordinary income, and hope your shares increase in value, which gets hit with capital gains tax when you sell. Either way, Uncle Sam takes his cut. But real estate? That's where things get interesting. Beyond the rental income and potential appreciation, real estate investors unlock a powerful third dimension of wealth building: paper losses through depreciation, even while their properties increase in value. Think about that for a second. The IRS actually expects your building to wear out over time, and they let you deduct this theoretical wearing out from your taxable income. But here's the kicker. Most properties actually appreciate in value over the long term. This creates a fascinating paradox where you're getting tax deductions for something that's actually making you richer. How exactly does this work? The tax code allows you to write off the cost of residential buildings, not the land, over 27.5 years. For example, if you buy a rental property for $500,000 and the building itself, excluding land, is worth $400,000, you can deduct about $14,545 annually, $400,000 divided by 27.5 from your taxable income. That's a $14,545 tax deduction you get automatically, without spending an extra penny out of pocket. For commercial properties, the depreciation timeline stretches to 39 years, but the principle remains the same. You're getting deductions for an expense that doesn't actually require any cash outflow. It's essentially a phantom expense that reduces your taxable income on paper. What makes this even more powerful is that this depreciation deduction isn't limited to offsetting just your rental income. In the right circumstances, which we'll explore soon, these paper losses can actually offset your other income sources like your salary or business profits. Compare this to stock market investors who typically pay taxes on almost every dollar they earn. Dividend income? Taxed. Capital gains when you sell? Taxed. Interest from bonds? You guessed it, taxed. There's very little room for creating paper losses that offset other income in traditional investment vehicles. But that's just the beginning of real estate's tax advantages. Unlike stock market investors, real estate owners can also deduct mortgage interest on their investment properties, property taxes, insurance premiums, maintenance expenses, property management fees, and various other operating costs. Each of these deductions chips away at your taxable income, creating a multi-layered approach to tax reduction that simply isn't available with most other investments. What's especially powerful about real estate's tax benefits is the concept of bonus depreciation. This allows investors to deduct a significant percentage of the cost of qualifying property components in the first year they're placed in service. This accelerated depreciation can create massive tax deductions in the early years of property ownership. However, there's an urgency factor here that savvy investors are paying close attention to. Bonus depreciation is currently being phased out. While it allowed for 100% deductions previously, it drops to 80% in 2023, then 60% in 2024, with further reductions until it's completely eliminated in 2027. This diminishing tax benefit has created a sense of urgency among investors looking to maximize their deductions before they disappear. What's the practical impact of all these tax advantages? Let's put it in perspective. A traditional investor might earn $100,000 in stock dividends and capital gains and end up paying $20,000 plus in taxes. Meanwhile, a real estate investor could generate $100,000 in rental income, but through depreciation and other deductions, show a much lower taxable income or even a paper loss, potentially paying zero in taxes while still pocketing real cash flow. The difference becomes even more dramatic at higher income levels. Traditional investors often face rising tax brackets as their income increases, while real estate investors can scale their tax advantages proportionally with their portfolio growth. The more properties you acquire, the more depreciation deductions you generate. This isn't just theoretical. It's precisely how strategic real estate investors structure their portfolios. They're not just thinking about cash flow and appreciation. They're deliberately creating tax-efficient investment vehicles that shield their income. The building might be physically gaining value and generating substantial cash flow, but on paper, the IRS sees a depreciating asset creating tax-deductible losses. Here's where things get truly fascinating. While the IRS allows you to deduct depreciation expenses over the life of your property, the reality is that most real estate actually appreciates over time. You're essentially getting tax benefits for an asset that's increasing, not decreasing, in value. It's like getting a tax break for driving a car that magically gets newer instead of older with each passing year. This unique advantage forms the cornerstone of advanced real estate tax strategy. While most investors focus only on cash flow and appreciation, savvy real estate investors understand they're playing a three-dimensional chess game where depreciation provides the crucial third dimension. What's particularly surprising is how the tax code incentivizes this approach. These aren't loopholes or sketchy maneuvers. They're specifically designed provisions within the tax code created to encourage real estate investment and development. Congress deliberately structured these benefits to stimulate housing development and property investment throughout the economy. The stark reality is that regular investors typically pay taxes on virtually all their income, while real estate investors can use depreciation to shield significant portions of their cash flow from taxation. This fundamental difference explains why real estate features so prominently in the portfolios of tax-conscious, wealthy individuals. Strategy number 1. Qualifying as a real estate professional. Most investors hit a frustrating wall when they discover their rental property losses can only offset other passive income, not their salary or business profits. But what if you could tear down that wall completely? This IRS-sanctioned status doesn't just bend the tax rules. It completely transforms them for those who know exactly how to qualify. Let's dive into the game-changing strategy that allowed Megan to use her property depreciation against her W-2 income, qualifying as a real estate professional for tax purposes. And let me be clear, this has nothing to do with getting a real estate license or selling properties. It's a special tax designation that separates casual landlords from serious real estate entrepreneurs. Here's why this matters so much. When you own rental properties, the IRS typically considers those investments passive activities, and any paper losses they generate, like that magical depreciation we discussed, can only offset other passive income. Got no passive income? Those valuable losses get suspended until future years when you might have passive gains. This limitation is known as the passive activity loss rules, and it's a major roadblock for most investors. But qualifying as a real estate professional for tax purposes changes everything. It reclassifies your rental activities from passive to non-passive, meaning those paper losses can now offset your regular income, your salary, business profits, even your spouse's income if you file jointly. For Megan, this was the critical first step in her tax elimination journey. The IRS doesn't hand out this status easily, though. To qualify, Megan needed to meet two strict requirements that the tax court enforces rigorously. First, she had to spend more than 750 hours during the year performing services in real property trades or businesses. Second, and this is where most people struggle, more than half of her personal services performed in all trades or businesses had to be in real estate activities. This presented a significant challenge for Megan. With her marketing position taking up over 2,000 hours annually, she'd need to somehow log more than 2,000 hours in real estate activities. Nearly impossible while maintaining her corporate career. Megan's solution was strategic and deliberate. She negotiated with her employer to reduce her marketing role to 25 hours per week, cutting her annual employment hours to around 1,300. This meant she needed to document at least 1,301 hours of real estate activities to satisfy the more than half requirement. She then committed to spending at least 30 documented hours weekly managing her portfolio of properties. This wasn't casual time. The IRS and tax court are incredibly strict about what counts as legitimate real estate activity hours. Megan focused on activities that directly contributed to the operation of her rental business. Finding and screening tenants, negotiating leases, collecting and tracking rent payments, handling maintenance requests, visiting properties, meeting with contractors, researching market trends to set competitive rents, and managing finances specifically related to her properties. What Megan learned through research, and what many investors miss, is that the IRS requires material participation in each rental property. This means you can't just log 750 hours across all properties collectively. You need to demonstrate significant involvement with each one. However, there's a strategic election investors can make, grouping all rental activities as a single activity, which simplifies meeting the material participation tests. The most critical aspect of Megan's approach was her documentation system. The tax court has consistently ruled against taxpayers who couldn't substantiate their claimed hours with contemporaneous records. In cases like Drosella versus Commissioner, taxpayers lost their rep status because they couldn't prove they spent more than 50% of their total working time on real estate activities. Megan implemented a detailed time tracking system that recorded the date and specific times she worked on real estate activities, which property each activity related to, detailed descriptions of the work performed, supporting evidence like emails, text messages, contracts, and receipts. She also learned what doesn't count toward the hour requirement. The tax court has ruled that time spent on education, research, or looking for new properties typically doesn't qualify because these activities aren't considered integral to the operations of existing rental properties. One case that guided Megan's approach was Penley versus Commissioner, where a taxpayer claimed to work over 2,500 hours on real estate activities while also holding a full-time job. The tax court found this claim unrealistic and denied rep status. Megan knew her records needed to reflect a realistic balance of time between her marketing role and property management. By reducing her traditional work hours and meticulously tracking her real estate activities, Megan successfully qualified as a real estate professional for tax purposes. This transformed her $707,000 in paper losses from passive to non-passive, allowing her to apply those losses against her W-2 income. Without this critical first step, her depreciation deductions would have been stranded, unusable against her marketing salary. For anyone considering this strategy, there's a critical difference between being a real estate professional for tax purposes versus being a licensed real estate agent or broker. Many real estate agents still don't qualify for this tax status because they work as independent contractors or employees of brokerages, not directly in property management, development, or other qualifying real estate businesses. Here's a pro tip most tax advisors won't tell you. If you're married filing jointly, only one spouse needs to qualify as a real estate professional for both to benefit. This creates a powerful opportunity for couples where one person can focus primarily on real estate activities while the other maintains traditional employment. The financial impact of qualifying for reps can be staggering. For Megan, it meant transforming unusable paper losses into actual tax savings of over $40,000 against her regular income. This single strategy effectively eliminated her tax liability. Strategy number 2, the cost segregation study that saved $43,000. Megan's qualifying as a real estate professional was just the first step in her tax reduction journey. Did you know the IRS actually lets you depreciate parts of your property in as little as 5 years instead of the standard 27.5 years? Most investors leave this money-saving opportunity completely untapped, but Megan was about to leverage it to dramatically accelerate her tax savings. With her rep status secured, Megan turned her attention to her largest asset, a $2.1 million apartment complex she'd acquired the previous year. Under standard depreciation rules, she could only write off the building portion, approximately $1.7 million, over 27.5 years, giving her annual deductions of about $62,000. While helpful, this wasn't going to make a significant dent in her tax bill. That's when her tax advisor suggested something most investors never consider: a cost segregation study. At first, Megan was skeptical about spending money on what sounded like just another expensive consultant report. But when her advisor explained the potential return on investment, she quickly recognized this wasn't just another expense. It was potentially her biggest tax advantage yet. So what exactly is a cost segregation study? In simple terms, it's an engineering-based analysis that identifies components of your real estate that can be reclassified from long-term, 27.5-year property to components eligible for much faster depreciation schedules. Instead of viewing her apartment building as one single asset, the IRS actually allows it to be broken down into dozens of separate components, each with its own depreciation timeline. Megan hired a specialized engineering firm that sent a team to thoroughly analyze her property. They conducted a detailed on-site inspection, photographing and measuring various components, reviewing building plans, and analyzing construction costs. Every aspect of the building was scrutinized, from the obvious elements like appliances and carpeting to less apparent components like electrical systems and land improvements. The results were eye-opening. The engineers identified significant portions of her building that qualified for accelerated depreciation schedules. $430,000 worth of components were reclassified as 5-year property, including appliances, carpeting, and removable fixtures. Another $215,000 was identified as 7-year property, covering items like furniture and specialized equipment in common areas. An additional $320,000 was categorized as 15-year property, which included landscaping, paved surfaces, and certain land improvements. This meant that nearly $965,000 of her property value, previously locked into the slow 27.5-year depreciation schedule, could now be written off much faster. Instead of tiny annual deductions spread over nearly 3 decades, Megan could front-load these deductions and realize enormous tax savings right away. The financial impact was immediate and substantial. In the first year alone, the cost segregation study created an additional $172,000 in depreciation deductions beyond what she would have received under standard depreciation. At her tax bracket, this translated to approximately $43,000 in actual tax savings, just from this one strategy. What makes this approach particularly powerful is that these aren't fictional deductions. They're fully sanctioned by the IRS, which recognizes that different components of a building wear out at different rates. Carpet doesn't last 27.5 years, so why should you be forced to depreciate it over that time frame? The tax code acknowledges this reality, but most investors never take advantage of it. The study itself wasn't cheap. It cost Megan about $8,000. But the return on investment was undeniable. Spending $8,000 to save $43,000 in a single tax year represents a 538% ROI, a return that would make even the most successful stock market investors jealous. And that's just the first-year benefit. The accelerated depreciation would continue providing advantages for years to come. What's particularly interesting about cost segregation studies is how they vary by property type. Megan's multifamily apartment complex yielded significant reclassifications because of its diverse components. Commercial properties can sometimes yield even more dramatic results due to specialized fixtures, while single-family homes typically offer fewer opportunities for reclassification, though still enough to make the process worthwhile for many investors. The process wasn't without challenges. The IRS scrutinizes cost segregation studies carefully, so proper documentation was essential. Megan's engineering team provided a comprehensive report detailing the methodology, property component breakdowns, and justifications for each classification. This documentation would prove invaluable if she ever faced an audit. It's worth noting that cost segregation studies become more cost-effective with larger properties. For Megan's $2.1 million apartment complex, the $8,000 study fee was easily justified by the tax savings. For smaller properties, investors need to calculate whether the potential tax benefits outweigh the cost of the study. Though many firms offer scaled pricing based on property value, an often overlooked aspect of cost segregation is how it enhances cash flow during the critical early years of property ownership. By front-loading depreciation deductions, investors like Megan can significantly reduce their tax liability when they're most likely dealing with renovation expenses, growing their portfolio, or paying down debt. This improved cash flow can be particularly valuable in high-interest rate environments, providing additional capital for further investments or property improvements. The complexity of a cost segregation study shouldn't be underestimated. While some investors attempt DIY approaches, Megan recognized that proper implementation required specialized expertise. Her team included tax advisors familiar with real estate taxation and engineers who understood both construction components and tax regulations. This collaborative approach ensured that her study would stand up to potential IRS scrutiny while maximizing legitimate deductions. One common misconception about cost segregation is that it creates new deductions. In reality, it doesn't increase the total amount you can depreciate. It simply accelerates the timeline, allowing you to take larger deductions sooner rather than later. This time value of money concept is crucial to understanding why cost segregation is so powerful. A dollar saved in taxes today is worth more than a dollar saved 10 years from now. For Megan, the cost segregation study represented a perfect second step in her tax strategy. Having qualified as a real estate professional, she could now use these accelerated depreciation deductions against her regular income. Without reps, these losses would have been limited by passive activity loss rules, significantly reducing their impact. The synergy between these two strategies multiplied their effectiveness. Strategy number 3, leveraging bonus depreciation before it disappears. The synergy between real estate professional status and cost segregation was powerful. But Megan was about to tap into a time-sensitive tax benefit that's literally vanishing year by year. The clock is ticking on a massive tax advantage that wealthy investors are scrambling to secure before the government phases it out completely. And while many people have never even heard of bonus depreciation, it's becoming the catalyst for a buying frenzy among savvy real estate investors. With her cost segregation study in hand, Megan was perfectly positioned to implement her third tax-slashing strategy, bonus depreciation. This powerful tax provision allows investors to immediately write off certain property components rather than depreciating them over several years. The beauty of this strategy is its simplicity once you've completed a cost segregation study. It's essentially turbocharging the benefits you've already unlocked. Many investors are accelerating property purchases to take advantage of the higher bonus depreciation rates before they decrease. Megan's CPA explained during their strategy session, "We need to move quickly." The urgency wasn't manufactured, it was based on cold, hard tax law. Under the Tax Cuts and Jobs Act of 2017, bonus depreciation is on a strict phase-out schedule. While investors once enjoyed 100% bonus depreciation, the benefit dropped to 80% in 2023 and is falling to just 60% in 2024. By 2025, it plummets further to 40%, and by 2027, it disappears entirely. This declining schedule has created a legitimate race against time for real estate investors. Each year you wait means thousands of dollars in lost tax benefits that can never be recaptured. Megan understood this immediately and made it a priority to implement this strategy while the percentages were still favorable. What made bonus depreciation so valuable for Megan was how it supercharged the results of her cost segregation study. All those components identified as 5-year, 7-year, and 15-year property, from appliances and carpeting to landscaping and various building systems, now qualified for immediate write-offs under the bonus depreciation rules. Let's break down what this meant for Megan's tax situation. Her cost segregation study had identified $430,000 in 5-year property and $215,000 in 7-year property. Without bonus depreciation, she would have had to spread these deductions over their respective recovery periods. But with bonus depreciation, she could immediately deduct the entire $645,000 in the current tax year. But that's not all. Bonus depreciation also applied to the $320,000 classified as 15-year property. While this category includes items like land improvements that depreciate more slowly than personal property, bonus depreciation allowed Megan to claim this entire amount in the current year as well. The results were staggering. In just one tax year, Megan generated a total paper loss of $707,000 from her real estate activities. Combined with her regular depreciation on the building's structural components, she created enough tax deductions to completely offset both her $200,000 in rental income and her $150,000 W-2 income, with significant losses carried forward to future tax years. Bonus depreciation applies to various items in real estate, including appliances, carpeting, tools, equipment, and land improvements, her CPA explained. These items can be classified as personal property or land improvements, allowing for accelerated depreciation. This strategy perfectly illustrates how the tax code can work dramatically in favor of real estate investors. While Megan's properties were generating positive cash flow and appreciating in value, the tax code allowed her to show substantial paper losses, creating the ideal scenario of making money while legally reducing her tax liability to zero. The genius of bonus depreciation is that it doesn't reduce the total amount you can depreciate. It simply accelerates when you can take those deductions. By front-loading these deductions into the early years of ownership, investors maximize the time value of money principal. A tax dollar saved today is always worth more than a tax dollar saved in the future. Megan's careful planning also demonstrated sophisticated tax strategy. By qualifying as a real estate professional first, then implementing cost segregation with bonus depreciation, she created a perfect storm of tax savings. Without rep status, her ability to use these accelerated deductions would have been severely limited by passive activity loss rules. The impact of this strategy goes beyond just the numbers. By eliminating her tax bill, Megan freed up cash flow that she could immediately redeploy into acquiring more properties, creating a powerful compounding effect on her wealth-building efforts. This is exactly how wealthy investors use the tax code to accelerate their path to financial freedom. While the average American might think tax planning means organizing receipts in April, sophisticated investors like Megan engage in proactive, year-round tax strategy. They don't just react to tax laws, they structure their investments specifically to capitalize on provisions like bonus depreciation. It's important to understand that these strategies aren't about cutting corners or finding loopholes in a negative sense. These are intentional incentives built into the tax code to encourage real estate investment, which provides housing and stimulates economic growth. Congress deliberately created these provisions, and investors who understand them are simply using the tax code as it was designed. The Tax Cuts and Jobs Act provisions significantly impacted real estate investors by allowing for immediate expensing of certain assets, which can lead to substantial tax savings in the early years of property ownership, noted a tax specialist familiar with Megan's strategy. The current environment for bonus depreciation is in flux, adding another layer of urgency for investors. With potential changes to tax policy always on the horizon, many are accelerating their acquisition timelines to lock in current benefits. As Megan's accountant pointed out, investors should consider conducting cost segregation studies as soon as possible after acquiring a property to ensure they maximize depreciation benefits under current law, especially given the impending reductions in bonus depreciation. For Megan, implementing bonus depreciation required precise documentation and coordination with her tax professional. The process involved carefully identifying which components qualified for the accelerated treatment and ensuring all paperwork was properly prepared for potential IRS scrutiny. This is not a DIY strategy. It requires professional guidance to implement correctly. The combination of reps, cost segregation, and bonus depreciation created a tax shield so effective that Megan actually began planning for future years when her accumulated deductions might run low. This forward-thinking approach is characteristic of sophisticated investors who don't just focus on this year's tax bill, but develop multi-year strategies. What's particularly powerful about Megan's approach is how she structured her entire real estate business with these tax strategies in mind. She didn't just buy properties and then think about tax implications later. She integrated tax planning into her acquisition strategy from the beginning, which maximized her benefits. For investors implementing this strategy, timing is everything. With bonus depreciation percentages dropping each year, every property purchased earlier rather than later stands to generate significantly more tax benefits. This explains why many real estate investors are accelerating their acquisition timelines, even in challenging market conditions. Strategy number 4, the 1031 exchange exit plan. What if you could sell a property that's gained $150,000 in value and legally walk away without paying capital gains taxes? While we've seen how Megan leveraged depreciation to shield her current income, she faced another challenge: how to cash out on her appreciating properties without losing a chunk of her profits to the tax man. This is where the magic of what investors call the 1031 exchange comes into play, and it might be the most powerful long-term wealth-building tool in the real estate investor's arsenal. Let's look at the situation Megan faced. After several years of owning her first duplex, market appreciation had pushed its value from $300,000 to $450,000. That's great news for her net worth, but potentially bad news come tax time. If she sold the property through a conventional sale, she'd be facing capital gains taxes on that $150,000 profit. Even at preferential capital gains rates, that could mean writing a check to the IRS for tens of thousands of dollars. But Megan had no intention of letting the IRS take a bite out of her profits. Instead, she implemented a tax strategy named after Section 1031 of the Internal Revenue Code. This provision allows investors to defer, not eliminate, but postpone indefinitely their capital gains taxes when they sell an investment property, as long as they roll the proceeds into another like-kind property. Now, you might be wondering what qualifies as like-kind property. The good news is that the IRS definition is surprisingly broad when it comes to real estate. Almost any investment property can be exchanged for another investment property. Megan could swap her duplex for a single-family home, an apartment building, a strip mall, or even raw land, as long as the property is held for investment or business use. Here's where timing becomes absolutely critical in executing a successful 1031 exchange. Megan had just 45 days from the sale of her duplex to identify potential replacement properties in writing. This isn't a casual deadline. It's strictly enforced by the IRS with no wiggle room, except in federally declared disaster areas. Then, she had to complete the purchase of her replacement property within 180 days of selling her original property. Miss either deadline by even a single day, and the entire tax deferral could be lost. But the timeline wasn't the only thing Megan needed to get right. A crucial rule of 1031 exchanges is that the investor can't touch the money during the transaction. If Megan received the proceeds from her duplex sale, even for a day, the exchange would be disqualified and all tax benefits would vanish. That's where a qualified intermediary, QI, became essential to her strategy. The QI is a neutral third party who holds the sale proceeds in escrow and handles the complex paperwork required for IRS compliance. Megan's QI facilitated the entire transaction, ensuring she never touched the funds and that all documentation was properly filed. Another critical requirement was that Megan needed to reinvest all of the proceeds from her sale to fully defer her taxes. If she pocketed any cash from the deal, what the IRS calls boot, that portion would be taxable immediately. Megan made sure her replacement property cost at least as much as what she sold her duplex for, avoiding any taxable boot. The impact of this strategy is staggering when you consider its scale. In 2023 alone, approximately $6 billion in taxes were deferred through 1031 exchanges across the country. That's billions of dollars staying in investors' pockets rather than going to the government, at least for now. This strategy isn't just about saving taxes today. It's about building substantially greater wealth over time. Think about it. That $30,000 to $40,000 that Megan would have paid in taxes can now continue working for her in her new, larger property. Over decades of investing, this compounding effect can create millions in additional wealth. What Megan essentially created was a tax-deferred growth machine. By implementing a series of 1031 exchanges throughout her investing career, she can continuously trade up to larger, more profitable properties without ever paying capital gains taxes on her accumulated wealth. It's like having an interest-free loan from the government that you can use to build your real estate empire. Let's look at how this played out for Megan specifically. She sold her duplex for $450,000 and identified 3 potential replacement properties within the 45-day window. She eventually closed on a 6-unit apartment building worth $900,000. By adding some of her cash reserves and taking on an appropriate mortgage, she was able to trade up to a much larger property while deferring all $150,000 in capital gains taxes. This trading up strategy creates a powerful snowball effect. Each property she acquires through a 1031 exchange can be depreciated from its new, higher basis, including the gains that would have been taxable from previous properties. This creates layer upon layer of tax advantages that compound over time. But what happens when Megan eventually wants to cash out completely? Won't those deferred taxes come due? Well, there are several exit strategies that sophisticated investors use. Some continue the exchanges until they pass away, at which point their heirs receive the property with a stepped-up basis to current market value, essentially eliminating all accumulated capital gains taxes. Others eventually convert investment properties to primary residences to capture exclusions available for personal homes. The beauty of this strategy is that it puts the investor in control of when, or if, they ever pay those capital gains taxes. It transforms tax payments from a certainty to a choice, allowing investors to time any taxable events strategically or potentially avoid them altogether. The complete system, how all strategies work together. Taking control of when you pay taxes is impressive, but some investors have discovered how to potentially eliminate their tax bills entirely. Ever wondered how someone earning $350,000 annually might legally pay less in taxes than someone making $50,000? The secret isn't hidden in any single strategy. It's in how these strategies work together as a comprehensive system. Think of it like this. Individually, each tax strategy we've covered is like a single musician playing a solo. Nice but limited. When orchestrated together properly, you get a symphony of tax benefits that can transform your financial picture completely. Let's break down why these strategies are so much more powerful when combined than when used separately. It's like mixing ingredients in a recipe. Separately, flour, eggs, and sugar aren't particularly exciting, but combined correctly, they create something extraordinary. The real magic happens in the integration. Take real estate professional status, REPS, as our starting point. By itself, REPS simply gives you permission to use real estate losses against other types of income. But what if you don't have significant losses to apply? That's where the limitations become apparent. REPS alone doesn't generate tax deductions. It just determines how you can use them. Similarly, a cost segregation study by itself identifies building components that can be depreciated faster, but without qualifying as a real estate professional, those accelerated depreciation deductions might be trapped in the passive activity category. For most investors, they just sit there and used or only offset other passive income. The IRS guidance on these matters makes it clear. While each strategy provides benefits, their true power emerges through strategic integration. When you combine cost segregation with bonus depreciation, for example, you create a powerful multiplier effect. The cost segregation study identifies which components qualify for shorter depreciation schedules. Then bonus depreciation allows you to claim those deductions immediately rather than spreading them out. But even this powerful combination has its limits if you can't use those deductions against your highest taxed income. That's precisely where REPS comes into play, removing the passive activity limitations and allowing these losses to offset your W-2 or business income. Think about it as building a dam system for a river. REPS opens the floodgates between different pools of income, cost segregation creates deeper reservoirs of deductions, and bonus depreciation accelerates the flow of those benefits to the present year. The 1031 exchange then completes the system by controlling the downstream flow of capital gains. What makes this integration truly remarkable is how each component addresses the limitations of the others. For instance, bonus depreciation is incredibly powerful but temporary due to its scheduled phase-out. Strategic planning becomes essential here. You'll want to maximize these benefits while they're still available at higher percentages. This is why wealthy investors don't just implement these strategies in isolation. They build comprehensive tax systems where each component enhances the others. Without this integrated approach, you might save some money, but you'll miss the exponential benefits that come from proper orchestration. Let's look at a practical example. An investor who only implements cost segregation might generate $100,000 in paper losses. But without reps, these losses would be suspended if they don't have sufficient passive income to offset. The same investor with reps but without cost segregation might qualify to use real estate losses against other income, but would only have standard depreciation to apply. Perhaps just $30,000 instead of $100,000. Compare that to an investor using both strategies together. They'd have $100,000 in accelerated deductions that can now offset their highest taxed income. Sources. The difference isn't just additive, it's multiplicative. The timing of implementing these strategies is also crucial. With bonus depreciation phasing out over the coming years, investors need to plan their property acquisitions strategically. Delaying a purchase by just 1 year could mean the difference between claiming 80% bonus depreciation versus only 60%. What's particularly powerful about this comprehensive approach is how it addresses both current and future tax liabilities. While depreciation strategies handle your current income tax situation, 1031 exchanges tackle your future capital gains taxes when you eventually sell properties. Together, they create a continuous shield against taxes throughout your investment lifecycle. This is why engaging with knowledgeable tax professionals is so essential. The strategies themselves are powerful, but their implementation requires precise timing and execution. A professional who understands both real estate and tax law can help ensure you're maximizing these benefits while staying compliant with IRS regulations. Remember that these strategies aren't just for the ultra-wealthy. While the dollar amounts may be larger for investors with substantial portfolios, the principles work at any scale. Whether you're dealing with a $200,000 rental property or a $2 million apartment complex, the same tax code applies. It's just a matter of scale. What's particularly interesting is how these strategies can adapt to changing market conditions. In appreciating markets, accelerated depreciation helps offset the increased income from rising rents. In declining markets, 1,031 exchanges allow you to pivot to stronger performing areas without triggering tax events. The comprehensive approach also creates remarkable financial efficiency. By reducing or eliminating tax burdens, investors can redirect those funds toward acquiring more properties, accelerating their wealth-building timeline. Every dollar not paid in taxes becomes capital for future investments, creating a powerful compounding effect over time. This systems-based approach to tax planning represents a fundamental shift in how successful investors think about their finances. Rather than viewing taxes as an inevitable expense to be minimized, they see the tax code as a strategic playbook for wealth building. For investors who fully implement this integrated system, the benefits extend beyond just tax savings. The improved cash flow from tax reductions can fund property improvements, increase tenant satisfaction, and ultimately drive higher property values. It creates a virtuous cycle, starting small benefits tax strategies for beginning investors, which in turn generates more tax benefits. That virtuous cycle of tax benefits isn't exclusive to real estate tycoons with massive portfolios. What if I told you that even with just one rental property, you could potentially access tax strategies that most Americans believe are reserved for the wealthy elite? I hear it all the time. Don't I need dozens of properties like Megan to make these tax strategies worthwhile? The answer might surprise you. While Megan's 12-unit portfolio certainly creates impressive tax benefits, the fundamentals of real estate tax advantages work at virtually any scale, even if you're just getting started with your first property. Let's break down how these powerful strategies scale for the everyday investor. Imagine you purchase a single-family rental for $300,000. With traditional depreciation, you'd typically write off about $8,700 annually. That's the building value spread over 27.5 years. Not bad, but certainly not life-changing. However, by implementing just one of the strategies we've discussed, a cost segregation study, you could potentially identify around $60,000 in components eligible for accelerated depreciation in the first year alone. That's nearly 7 times more tax benefit in year 1 compared to standard depreciation. Even after accounting for the cost of the study itself, the return on investment can be substantial. And here's the kicker. With bonus depreciation still available, though phasing down each year, you can potentially claim that entire $60,000 deduction immediately rather than spreading it out. For new investors, the tax journey typically begins with selecting the right entity structure. While many default to using their personal name on property deeds, establishing an LLC that's either disregarded for tax purposes, for solo investors, or taxed as a partnership for multiple owners, provides both liability protection and tax flexibility. This foundation becomes increasingly valuable as your portfolio grows, allowing for more strategic planning down the road. But I only have one rental property. Is it really worth bothering with all this paperwork? Absolutely. Even with a single property, the difference between casual and strategic tax planning can mean thousands in your pocket. The key is understanding which expenses are immediately deductible versus those that must be capitalized and depreciated. Did you know that something as simple as knowing the difference between a repair and an improvement can significantly impact your tax situation? Repairs, which maintain your property in its normal operating condition, are fully deductible in the year you pay for them. That new water heater that replaced a broken one? Likely a repair. But if you upgrade from a standard water heater to a tankless system that increases the property's value, that's an improvement that must be capitalized and depreciated over time. Small-scale investors should also pay close attention to income thresholds for certain tax benefits. For instance, if your modified adjusted gross income falls under $100,000, the IRS allows you to deduct up to $25,000 in rental real estate losses against your ordinary income, even without qualifying as a real estate professional. This deduction gradually phases out for incomes between $100,000 and $150,000, making it a valuable planning opportunity for beginning investors. Let's talk about record keeping, which is perhaps the most accessible yet underutilized tax strategy for small portfolios. Tracking every expense, from driving to your property, to the home office space you use for managing it, to the subscription fees for landlord software, creates legitimate deductions that many beginning investors miss. Even that dinner where you discuss property management with your spouse could be partially deductible as a business meeting. Tax planning isn't just about the big strategies. It's also about consistency with the small ones. Create a system to capture receipts immediately, whether through a dedicated app or a simple folder in your email. Set calendar reminders for property visits and maintenance checks, documenting each activity as it happens. These habits not only maximize your deductions, but also create an audit trail should the IRS ever come knocking. Timing is another powerful lever, even for single property owners. If you're planning property improvements, consider whether bunching them in a high-income year makes sense tax-wise. Similarly, collecting December rent in January can shift income to the following tax year. A simple strategy that requires no fancy paperwork or professional qualifications. The compounding effect of these seemingly small decisions adds up dramatically. Consider two investors who each buy identical $300,000 rental properties. Investor A takes standard depreciation and casually tracks expenses. Investor B implements cost segregation, meticulously documents all activities, and strategically times income and expenses. After 5 years, Investor B might have legally kept $20,000 plus more in their pocket, capital that can accelerate the purchase of their next property. What about the real estate professional status we discussed with Megan? While that might seem out of reach for investors with full-time jobs, it's worth planning for as your portfolio grows. Could your spouse potentially qualify if they have more flexible work arrangements? Could you structure a career transition in the coming years to meet the requirements? These long-term strategic questions are worth considering even in your first year of investing. The beauty of starting with strong tax fundamentals is that they create a framework that scales seamlessly as your portfolio grows. The habits and structures you implement with property number 1 become increasingly valuable when you're managing properties number 5 and number 6. Each additional property amplifies the benefits of your tax strategy rather than requiring an entirely new approach. Remember that timing consideration we discussed earlier? For newer investors, this extends to when you conduct your cost segregation study. While the study can technically be performed years after purchase through a look-back process, implementing it in the year you acquire the property ensures you maximize the current bonus depreciation rates before they further decrease, avoiding common mistakes and surviving an IRS audit. While timing your cost segregation study correctly is smart, Even the most brilliant tax strategy becomes worthless without one critical element. The IRS has a secret checklist specifically designed to catch real estate investors using aggressive tax strategies. And their number one audit trigger isn't what most investors expect. Let's be honest. All the tax strategies we've discussed are completely legal, but they can quickly turn into an expensive nightmare if you make one fundamental mistake: failing to maintain proper documentation. It's not just about having the right strategy. It's about being able to prove you actually did what you claimed on your tax return. The IRS is ramping up its scrutiny of real estate investors, especially those claiming real estate professional status. Why? Because the tax benefits are substantial, and they know many investors try to qualify without meeting the strict requirements. Their audit teams are specifically trained to look for red flags in your documentation, or worse, the complete absence of it. Remember the Zaid Hackett case from 2020? The tax court ruled that ballpark guesstimates and undocumented testimony weren't enough to prove material participation in real estate activities. The judges weren't impressed with after-the-fact estimates of time spent. They wanted to see contemporaneous records created at the time the work was performed. When the IRS examines your real estate professional status claim, they're looking for specific indicators that you didn't actually meet the requirements. Their audit technique guide specifically flags individuals who aren't compensated for their property management services, have demanding full-time jobs, or rely heavily on paid property managers to handle day-to-day operations. What's really shocking is that in many cases, taxpayers actually did qualify for the tax benefits they claimed. They just couldn't prove it when challenged. In the recent Drosella case last year, the taxpayers couldn't demonstrate they spent more than 50% of their total work time on real estate activities. They likely performed the work, but without meticulous documentation, the tax court ruled against them. So what kind of documentation do you actually need? For starters, detailed daily time logs are essential. Not just worked on rental properties, 8 hours, but specific entries like 9:15 to 10:30 a.m. Called 3 plumbers for quotes on Unit 4 bathroom leak. Scheduled appointment with ABC Plumbing for Thursday. The more specific, the more credible. Electronic records are incredibly valuable for establishing your real estate activities. Save every email communication with tenants, contractors, and property managers. Take date-stamped photos of property visits and maintenance work. Keep digital calendars updated with all property-related appointments and activities. Each piece builds your case that you were genuinely involved in managing your properties. For cost segregation studies, DIY methods are a major red flag. Remember that a proper study requires engineering expertise to correctly classify building components. The IRS expects supporting documentation for every component that's been reclassified for accelerated depreciation. Those kitchen cabinets you're depreciating over 5 years instead of 27.5 years? You need the engineering report that justifies that classification. Documentation requirements extend to every aspect of your tax strategy. For 1031 exchanges, maintain complete records from your qualified intermediary, including proof that you identified replacement properties within 45 days and completed the purchase within 180 days. Missing even one deadline can invalidate the entire exchange and trigger massive tax bills. Here's something many investors don't realize. The burden of proof lies with you, not the IRS. When they issue a notice of deficiency claiming you owe additional taxes, it's your responsibility to prove they're wrong. Without proper documentation, you'll likely lose the case even if you actually qualified for the benefits you claimed. Smart investors create systems for documentation before implementing tax strategies. Set calendar reminders for daily time tracking. Create digital folders for each property to store all communications and records. Take photos of every property visit and improvement project. Save receipts for every expense, no matter how small. One particularly effective approach is maintaining a dedicated email address solely for real estate activities. All property-related communications flow through this address, creating an automatic digital paper trail that's searchable and time-stamped. Combined with a cloud-based document storage system, you'll have access to your proof anywhere, anytime. Physical documentation matters too. Keep a separate business credit card for all real estate expenses to create a clear financial record. Maintain a mileage log for property-related travel. Save physical copies of contracts, leases, and major expense receipts in a dedicated filing system. In an audit, physical evidence can be particularly compelling. Here's a real-world perspective on what happens in an audit. The IRS examiner doesn't care about your intentions or verbal explanations. They only care about what you can prove with documentation. If you claim 1,000 hours of real estate activities but can only document 700, those undocumented 300 hours simply don't exist in their eyes. The IRS is especially vigilant about material participation. If you claim to actively manage your properties but outsource most work to property management companies, you'll need to document your oversight activities meticulously. Phone calls, emails, approval of repairs, tenant screening decisions, all of these count, but only if you can prove they occurred. For married couples, another common mistake is claiming real estate professional status without clarifying which spouse qualifies. The IRS will examine both spouses' activities separately, so be clear in your documentation about who performed which activities. Remember that contemporaneous records are far more credible than records created after the fact. The moment the IRS sees documentation created right before an audit, red flags go up. Maintain your records throughout the year, not just at tax time. Another commonly overlooked aspect is the need to document not just the quantity of hours, but the nature of the activities. The IRS distinguishes between investor activities, researching properties, attending seminars, and material participation, managing existing properties. Only the latter counts toward real estate professional status, so clearly categorize your time accordingly. Ultimately, the difference between success and failure in an IRS audit often comes down to one thing. Was your tax strategy properly documented? I've seen investors with legitimate tax positions end up owing tens of thousands in back taxes, penalties, and interest simply because they couldn't produce the records to support their claims. Finding the right tax professional, questions to ask. Even with perfect documentation, your tax strategy is only as good as the professional who designs it. Here's a shocking truth. Most CPAs have zero specialized training in real estate tax strategies, yet confidently file returns for property investors every year. Finding someone who truly understands the complexities of real estate taxation can be the difference between paying thousands in unnecessary taxes and keeping that money working for you. When Megan realized she needed expert help with her tax strategy, she didn't just call the first accountant in the phone book. She conducted a methodical search, interviewing 5 different tax professionals before finding the right fit. This careful selection process paid off tremendously. The difference between the strategies proposed by the best and worst candidates would have cost her tens of thousands of dollars annually. But how can you tell if a tax professional truly knows their stuff when it comes to real estate? The answer lies in asking the right questions during your initial consultation. These questions serve as a litmus test, quickly revealing whether you're talking to a general tax preparer or a true real estate tax strategist. First, ask them directly. How many real estate investors do you work with? This seems simple, but it's incredibly revealing. A specialist should work with dozens of investors, not just a handful. There. Answers should include specifics about the types of investors they serve, from small-scale landlords to large portfolio holders. If they can't give you a clear number or percentage of their practice dedicated to real estate investors, that's your first red flag. Second, probe deeper with. Have you helped clients qualify as real estate professionals? This question tests their knowledge of one of the most powerful tax strategies available. Listen carefully to their response. They should explain not just what the status is, but how they've helped clients document their hours, structure their activities, and successfully implement this strategy. If they seem hesitant or give vague answers, they likely lack real-world experience with this critical classification. The third question cuts to the heart of advanced strategies. How many cost segregation studies have you implemented? A knowledgeable advisor won't just know what a cost segregation study is. They'll have experience working with engineering firms, interpreting the results, and incorporating the findings into their clients' tax returns. They should be able to tell you about specific cases where they've used this strategy and the typical results they've seen. Fourth, ask about their experience with 1031 exchanges. What's your experience handling 1031 exchanges, and what common pitfalls have you helped clients avoid? Their answer should demonstrate practical knowledge of the strict timelines, qualified intermediary requirements, and replacement property rules. A true specialist will share war stories about exchanges they've managed and how they've navigated complex situations. Finally, don't just focus on what they say. Pay attention to what they ask you. The right tax professional should proactively inquire about your entity structure, state tax implications, and self-employment tax considerations. These elements form the foundation of a comprehensive tax strategy, and an experienced advisor will want to understand your current situation before making recommendations. Price comparisons can also be revealing. In Megan's search, she found wide variations in fee structures. One CPA quoted $1,500 for tax preparation plus ongoing guidance throughout the year, while another charged $2,800 upfront with a monthly fee of $100. These differences often reflect the level of specialized service and expertise you'll receive. The cheapest option is rarely the best when it comes to specialized tax planning. Be extremely cautious of any advisor who promises guaranteed results or specific tax savings without thoroughly reviewing your situation. Tax strategies must be tailored to your specific circumstances, and a responsible professional will discuss potential audit risks along with the benefits. As one of Megan's candidates told her, "I'm not here to help you evade taxes. I'm here to help you legally avoid them through strategic planning." When evaluating potential advisors, look for certifications or designations that indicate real estate expertise. While being a certified public accountant, CPA, is important, it's not enough on its own. Additional qualifications in tax law or real estate investment can signal deeper knowledge in this specialized area. Clear communication is another essential quality. The right professional should be able to explain complex strategies in terms you understand, ensuring you're making informed decisions about your tax planning. If they can't break down concepts like bonus depreciation or material participation in simple language, how will they educate you about your options? Consider testing their knowledge with a specific scenario relevant to your situation. For example, you might ask, if I purchase a $500,000 rental property this year, what tax strategies would you recommend I implement immediately, and how would they benefit me? Their answer will reveal both their technical knowledge and their ability to tailor strategies to individual circumstances. Don't hesitate to request references from other real estate clients. Speaking with existing clients can provide valuable insights into the advisor's expertise, responsiveness, and results. Most qualified professionals will gladly connect you with satisfied clients who can vouch for their services. Remember that the right tax professional isn't just someone who files your return. They should be a strategic partner in your wealth-building journey. They should meet with you throughout the year, not just during tax season, to ensure your investments and activities are structured optimally from a tax perspective. The difference between an average tax preparer and a specialized real estate tax strategist can be enormous. One of Megan's investor friends learned this lesson the hard way, paying over $37,000 in unnecessary taxes because her accountant didn't understand cost segregation or bonus depreciation rules. When she switched to a specialized tax professional the following year, she legally reduced her tax bill by more than 60%, all by implementing strategies her previous accountant never mentioned. Your action plan, next steps based on your current level. Now that you've seen the kind of tax magic a pro like Megan can work with her impressive 12-unit portfolio, let's bring things back down to earth. What should you be doing right now, based on where you are in your real estate journey? Think of tax strategy like building a house. You wouldn't start by installing the roof before laying the foundation, right? Yet that's exactly what happens when excited investors try jumping straight to advanced strategies they heard about online before they've established the basics. Starting with the wrong strategy at the wrong time is like buying an expensive sports car when you haven't even learned to drive yet. Let's create a customized roadmap based on your current portfolio size to make sure you're not leaving money on the table. For beginners with just one property, or maybe you're still shopping for your first, your tax strategy needs to focus on building a solid foundation. First, establish proper record-keeping systems. This isn't the sexy stuff, but it's absolutely crucial. Create dedicated folders for each property, separate bank accounts for rental activities, and systems to track every single expense. At this stage, your primary focus should be understanding basic deductions that apply to all real estate investors. Mortgage interest, property taxes, insurance, repairs, and travel expenses related to your property. These fundamentals alone can save you thousands each year. Don't overlook entity selection just because you're starting small. An LLC can provide crucial asset protection and set you up for optimal tax treatment down the road. While you might not need the most complex structures yet, getting this right from the beginning prevents headaches later when your portfolio expands. One beginner investor I worked with saved over $3,000 in her first year just by implementing proper record-keeping systems that helped her identify deductions her previous tax preparer had missed. That's money she reinvested into her next property purchase. Once you've graduated to the intermediate level with 2 to 5 properties, it's time to level up your tax game. This is where cost segregation studies start becoming more cost-effective, especially if you've acquired larger properties like small multifamily buildings. At this stage, you should also explore whether qualifying for real estate professional status might be achievable. Maybe you can negotiate reduced hours at your day job, or perhaps your spouse can take on more property management responsibilities. Remember, only one spouse needs to qualify for both to benefit on a joint return. A tax planning calendar becomes essential at the intermediate stage. Create a schedule that reminds you of estimated tax payments, documentation deadlines, and optimal timing for implementing new strategies. Tax planning isn't just an April activity. It's year-round work that pays massive dividends. One of my clients with 3 rental properties implemented a quarterly tax planning session with her accountant. By checking in regularly instead of just at tax time, she identified opportunities to accelerate certain expenses into high-income years and defer income when beneficial. This proactive approach saved her nearly $12,000 in a single year. Advanced investors with 6+ properties can implement the full arsenal of tax strategies we've discussed. At this level, you should seriously consider qualifying for real estate professional status if you haven't already. The tax benefits multiply exponentially with each property you add to your portfolio. Portfolio-wide cost segregation studies become incredibly powerful at this stage. Instead of evaluating each property in isolation, you can strategically time these studies across multiple properties to maximize your tax savings in specific years when you expect higher income. Bonus depreciation planning takes on new importance for larger portfolios. With the phasing out of these benefits, dropping to 40% in 2025, advanced investors should work with their tax professionals to potentially accelerate property acquisitions or improvement projects. 1031 exchange strategies become central to your long-term wealth building at this stage. You're likely to have properties that have appreciated significantly, and developing a portfolio-wide exchange strategy can help you continuously upgrade to larger, more profitable properties while deferring taxes indefinitely. One advanced investor I know accumulated over $4 million in property value over 15 years without ever paying capital gains taxes, using strategic 1031 exchanges to constantly trade up. The compounding effect of keeping those tax dollars working in his portfolio instead of sending them to the IRS has been extraordinary. Regardless of your current level, I can't emphasize enough the importance of starting with a comprehensive tax strategy session with a qualified professional. This isn't just about preparing this year's return. It's about creating a multi-year roadmap tailored to your specific situation and goals. During this session, your tax strategist should analyze your current income sources, investment timeline, risk tolerance, and growth objectives to create a personalized plan. They should also help you anticipate how changing tax laws, like the scheduled 2025 changes, might impact your strategy in the coming years. Remember that tax strategies work best when planned before purchasing properties. I've seen countless investors leave thousands on the table because they only thought about tax implications after closing on a property. The best tax moves happen before you sign on the dotted line. For example, purchasing a property in December versus January can make a huge difference in your current year tax situation. The same property bought just a few weeks apart could either generate valuable deductions for this year's taxes or delay those benefits until next year. So what's the very first tax strategy to implement if you're just starting with real estate? Begin with proper entity structure and rock-solid record-keeping systems. These fundamental building blocks might not sound exciting, but they create the foundation that supports all the advanced strategies we've discussed. From there, gradually implement more sophisticated strategies as your portfolio grows. Each new property you acquire opens up additional tax planning opportunities, creating a virtuous cycle where tax savings fund new investments, which generate more tax savings, and so on. Let's be real. What we've seen through Megan's journey isn't some mystical tax magic. It's the deliberate application of incentives that already exist in our tax code. The government has intentionally created these benefits to encourage real estate investment, knowing it stimulates economic growth, creates housing, and develops communities. The economic rationale is simple. When investors like you put money into properties, you're not just building your own wealth. You're creating jobs, improving neighborhoods, and providing housing. That's precisely why the IRS allows depreciation and numerous other deductions. The beauty of real estate investing lies in its triple threat of benefits: building wealth over time, creating consistent income streams, and providing a powerful hedge against inflation, all while the tax advantages enhance your overall returns. So start where you are today. Whether that's researching your first property or optimizing what you already own, remember that these strategies are accessible to anyone willing to learn. With the right professional guidance and a commitment to understanding these principles, you can begin constructing a tax-efficient portfolio